When you've spent decades building your wealth, it's only right that your withdrawals and retirement don't go straight to Uncle Sam. A few smart moves, made in the right order, can help you keep more of your money working for you and your loved ones. But tax efficiency in retirement isn't just about avoiding mistakes. It's about having a strategy that spans your entire retirement. Today, we'll walk through 5 strategies to help you make smarter, lower tax withdrawals. So Spencer, before we dive into the actual strategies of taking withdrawals, talk us through tax location optimization, because this can really help us as we think about where assets need to be located and what types of accounts.
Well, we want to generally have more of our growth assets in Roth resources. So if we have the highest growth assets being public and private equity, something like direct corporate lending, that would be an alternative type of investment. Maybe reinsurance. These would be where we would typically put those resources would be in the Roth side, because we want to have as much tax-free growth as possible. When we think about the pre-tax side of things, that's where we would oftentimes put our bonds, because we're not going to pay interest, tax on the interest, I should say, that they earn. So our treasury bonds or our corporate bonds or other types of resources that would kick off a bunch of income, we wouldn't necessarily want to put those in our non-qualified types of resources where we're having to pay tax on those on an annual basis. So oftentimes we want to put bonds, and particularly like high yield bonds would be nice to put in the pre-tax environment, along with corporate and treasury bonds that we would put there. Now, there's typically also equities and alternative investments in that pre-tax side of things, because oftentimes that bucket is the biggest of the buckets. But we want to recognize that we're putting assets in there that might have a slower growth sequence there. But if we keep them there, whenever we might need them because a market downturn happens, we can pull them out. And if they don't have quite as much growth on the upside, well, we also don't pay as much tax on them as we would the Roth side of things. Now, the third piece, of course, is non-qualified, and that is where we would want to be careful in terms of what we put in there. Typically, if we have the opportunity, we would put in stocks and really be looking towards being thoughtful about harvesting any long-term capital gains on those stocks. We might have municipal bonds in there. We might even have other types of investments in there, but we would want to shy away in that account in particular for investments that would be like direct corporate lending, or would be, say, real estate investment trusts, where they're more growth-oriented in nature, but their growth comes from the interest that is paid. So oftentimes we would look at the real estate investment trust, for instance, and we would try to position those potentially in the Roth or in the pre-tax side of things, because the bulk of the gain, again, comes as ordinary income rather than as long-term capital gain or as a qualified dividend. So we want to be careful as we structure this overall, even before we think about where to withdraw funds from, because that location optimization based on the account type can be a really nice lever that can help us.
Absolutely. Okay, so let's now shift from the location optimization to the actual withdrawal strategy. So you want to talk us through our typical withdrawal strategy?
Well, we say typical here because we think about the strategy that a lot of folks will employ as they begin their distributions. So as they get into retirement and they think the first 5 to 10 years, of retirement oftentimes, and this would be non-qualified first, pre-tax resources second, and then Roth resources third. The non-qualified resources being taken first, primarily because they're going to be the least tax efficient places to pull resources from. So if we think about having, some basket of investments there in the non-qualified side of things, we're going to pay tax every year on interest income, dividend income. If we harvest any long-term capital gains or short-term capital gains for that matter, we're going to pay tax on that. And that tax bill accrues over time. So let's just say that you own a treasury bond and you put $100,000 in there and you get a 4% interest payment on an annual basis. Well, you pay $4,000, you're paid $4,000 in that first year of income. And let's say you have to pay 25% in tax on a federal and state level. Well, you pay that 25% in tax. Well, now we've got a set of circumstances where we've only got $3,000 left. But that $3,000, as it accrues interest, we're paying tax again on that. So you get hit with a tax bill every year, whereas you're able to allow those resources to grow tax in a tax advantageous way, both on a pre-tax type of traditional IRA or rollover IRA or 401k type of investment, or in a Roth IRA or Roth 401k type of investment. So we've got to be very careful as we think through where to draw from first, that non-qualified resources being first, pre-tax being second, and then ideally you save the Roth as long as you can. Now you may need to take from Roth resources. Let's just say again, the tax regime changes here in a few years. We have a higher tax brackets. What you may find is that you take required minimum distributions from your pre-tax resources, but then let's say you wanted to take a trip, with your family, and it's going to be another $20,000 and you need to take it from somewhere. Why, you may want to take it from Roth rather than pre-tax, because if you take it from pre-tax, it's going to bump you up to that next tax bracket. You may have Medicare surcharges and things like that as well. So the Roth ends up acting as a buffer, but you hold it as long as you can there, and you're strategic with it.
Right. So Spencer, why is it so important then to take a long-term approach to tax and not just a short-term, 1 year, this is what I need to do this year?
Well, if we optimize for this year, oftentimes we're not thinking about the next 5, 10, 15, even 20 years of tax payments. So we could artificially keep taxes really low for clients in any given year. But what we want to think about is what's going to be the tax bill over the next period of time. So for a lot of our clients, as they're just getting into retirement, we're kind of planning out 3 decades, even more sometimes. We want to think about what their likely tax bill will be over the course of time, and not just trying to keep their tax bill at just a couple $1,000s for that first tax year. And the rationale there is they may have non-qualified resources, and they may have some of those non-qualified resources that they're not paying much tax on. They may not have a lot of gain in there, maybe bonds. And so if we just took resources from there, didn't harvest any long-term capital gains, didn't have any kind of Roth conversion, didn't have other kinds of income, maybe not even taking Social Security at this point, they could have all the resources that they need for their spending and living and giving, all those kinds of things, might pay zero in tax, but might be having a big tax bill down the road. So what we want to do is we want to say, okay, what's that marginal tax rate that's likely to be the highest there? And then how do we bring that down? We may be looking 10 years into the future, and maybe they're looking at staring a 32% marginal tax bracket in the face in 10 years when required minimum distributions really kick in. Well, what can we do now to start doing some Roth converting, in the midst of things? So it may be that it's helpful to do a $100,000 or $150,000 Roth conversion right now while we have the opportunity, because they don't have as high level of income. That would be very typical among our clients, because they might be living off of those non-qualified resources that don't generate much of a tax bill, relatively speaking, but they might have a big pre-tax traditional IRA, let's just say, with RMDs coming down the pike. They might have deferred Social Security, and they might have several $100,000s of income likely to come in with a big tax bill down the road. So what we want to do is look at the extended picture and do Roth converting, strategically. We'll talk about that a little bit more here in a moment, but also coordinate that with other pieces. Now, the final caveat that I'd have here that is kind of counter to what we've talked about in the general sequence of non-qualified to pre-tax to Roth is that if we have clients that are closer to the end of life, let's say we have clients in their mid-90s and they have significant long-term capital gains and their non-qualified account, and they reach out to us and say, well, I need to take a $50,000 distribution to help pay for some repairs on my home, something like that. It may be that we still look at the non-qualified account, but it might be that we look at the traditional IRA in that set of circumstances, because those non-qualified resources, if they pass away, they have a step up in cost basis. Whereas if they pass along those pre-tax resources to a son or daughter, then the son or daughter may be paying tax on those. So somebody's going to pay tax on those at some point. Whereas the non-qualified resources with those big capital gains, they might not pay tax on that because there's a step up in cost basis at that owner's passing. So we have to be really careful, even with this general guidance, that we look at each situation and we put together that distribution strategy. And sometimes it's different year to year. Even you could have someone who's in their mid-90s and they're in perfect health, and then a year later, they're in a nursing home.
Right.
Well, their deductions just went way up, their itemized deductions, and we might be taking distributions exclusively from the traditional IRA at that point because they can be offset by all those itemized deductions there. So lots of different nuance to this, but generally speaking, again, that would be the sequence that we would look through.
Great. So kind of dovetailing with that bigger picture strategy, how do we think about coordinating Social Security benefit timing with the withdrawal strategy?
Well, first we want to put a pin in this to say we don't know where Social Security Administration is going to go in terms of the benefits that are offered. For most of our clients, we also look at it and we say, irregardless of taxes and the tax that might be due on Social Security, typically a strategy that defers Social Security out to age 70 for a high earning individual makes a lot of sense in a lot of scenarios. With that having been said, usually what we want to do is also coordinate the Social Security claiming strategy with the tax strategy. So what typically will happen is we'll say, okay, let's defer Social Security as long as we can to up those benefits, because if you were getting, if you had a full retirement age, for instance, at age 67, and you were going to get $3,000 on a month-to-month basis of benefits, you would have a much, much higher level of benefit there, over $3,700 if you defer those 3 years, with a break-even point there probably in your early 80s. So if we look at that though, and if we're deferring, what we want to recognize is that the amount of income is going to be increased there at age 70. What we would like to do is then to do the planning, and let's say we have clients that retire in their early 60s, let's say age 62, we may have 8 years there where we're trying to have them live off of non-qualified resources and pre-tax resources, and then also do Roth conversions such that down the road, when their required minimum distributions start, they might be less and more manageable because they've done some Roth converting and therefore have more flexibility to keep more of those Social Security dollars out of being taxed.
Right.
As a quick reminder, Social Security income is taxed in a weird way. Not all of it is included in taxable income. Up to 85% can be. There's a calculation, again, that we'll put in the show notes there with other episodes that we've done with respect to provisional income. And what we'd like to do is, at least from age 70 up to your required minimum distribution beginning date, that potentially you have little tax on your Social Security income because you've got a higher level of income there, and then maybe you're able to just use non-qualified resources or something like that.
Right. So Spencer, one of the things that we need to address when we're thinking about Social Security planning and the tax implications of Social Security is that tax torpedo. And this can be really hard to understand how it's happened. So can you try to walk us through the Social Security tax torpedo?
Yeah, so Social Security, as we talked about, is taxed via this calculation called provisional income. Provisional income is basically a calculation where you take half of Social Security and everything else, including your even your municipal bond income, and you add that together, and that's your provisional income number. So at the most extreme level here, let's just say you had $64,000 of Social Security income between you and a spouse. Then your provisional income, if you had nothing else, you would have $32,000 of provisional income. If you have $32,000 of provisional income, that's kind of that lowest level where now you're not having any of your Social Security included in your ordinary income. So $64,000, that's a lot of income from Social Security and none of it being included. We've seen clients even that would have $90,000 of that level of income. So now we have $45,000 as provisional income. Well, based on the fact that they also have a standard deduction, they might have $90,000 of Social Security income and pay zero tax on that if that's all that there is. So sometimes that's very, very surprising. Now, the challenge is that when they're in that state, let's say you have $90,000 of Social Security income, every dollar of other income that you have, even if it's municipal bond income, every other dollar of modified adjusted gross income that you get pulls in at that level 85 cents of Social Security to be brought into ordinary income. So it's almost a doubling up there. So we have to be really careful that, and even if that's dividend income or long-term capital gains, that are harvested, it still would be included because that's modified adjusted gross income. So we have to be really careful there because that stacks up really quickly. It can go from zero tax, and if we're looking at it and we're at a 12% tax bracket, or even worse, oftentimes at a 22% tax bracket, you think about almost a time and a half of 22%, we're getting up to a marginal tax there that would be 40% or even more.
Right.
So that can be really, really punitive, and we want to be careful with that.
Right. And I think the confusing piece about this is you're not necessarily jumping into a new bracket. It's because now you had zero Social Security income in there that was taxable. Now you have it added as taxable. So you don't necessarily jump to the 37 or the 32% bracket. It's that you went from it's not included to it's now included. And I think that can be the really complex, challenging piece to understand is that it's not that you're necessarily breaking brackets. It's that, okay, now you actually have to pull it into what is a taxable income.
Right. You were getting a benefit. The federal government was saying basically, we're not going to pay attention to any of the Social Security. And then all of a sudden they say, we're going to really start paying attention here and you're going to have to pay tax on it. Right. And that tax torpedo is surprising because it can actually go above and beyond, like you talked about, the 37% tax bracket. So you pay nothing, nothing, nothing. And then every dollar you're paying 37 cents on, you're paying more than 37 cents on the dollar for a number of those. And then it drops back down.
Yeah.
And then, it kind of works its way back up.
Right.
So it's with Social Security income in particular, we've got to be careful because it can hit us really hard in unexpected ways if we're not doing the planning correctly.
Yeah, absolutely. Okay, so we've talked about Roth conversions a couple times. You mentioned them during the Social Security piece. Why do we think about doing Roth conversions strategically and not just because the media said, hey, taxes are cheap, do a Roth conversion now? Well,
it's a pay me now or pay me later type of scenario. So if you have investments and you know that you're either going to pay 12 cents on the dollar now or 22 cents on the dollar, in 5 years, or 32 cents on the dollar in 10 years, what would you rather do? Well, most folks would say, well, I'm going to go ahead and pay 12 cents on the dollar right now. Now, of course, we don't know what's going to happen in 10 or 20 years, but we have a high level of likelihood that if we have a client that's deferring Social Security income and is having required minimum distributions coming in later on at a high level, that their income is going to be higher than what it would be early in retirement, and that they're going to have a higher marginal tax bracket associated with that. So we'll never know for certain when we do this kind of planning. But again, it's that pay me now or pay me later, pay me a little now or pay me more later. And most clients would say, well, I'd rather have the certainty of that. The only caveat here is what we would say if you do not have heirs that are people.
Yeah.
If you want all of your resources to go to charitable institutions, then having all of those in pre-tax makes a whole lot of sense, because if you do a Roth conversion early, then you may have paid the federal government for that conversion and may not have needed to. You may have been able to pass those resources on pre-tax at your passing to whatever charitable institutions that you would choose there. So we also need to layer in here who are your beneficiaries, and what does that planning need to look like there?
Yeah. All right. So Spencer, the last piece that we want to discuss is legacy and beneficiaries. And you kind of already touched about this when you were talking about Roth conversions, and we don't want to convert to Roth if all of our assets are going to charities, but we need to think about specifically who are the next stewards, who are the next ones that are going to receive these resources, and what are their tax implications? So why is this so important?
Well, ideally, again, you're not leaving the federal government with a tip when you die.
Yeah.
So you'd prefer not to give the federal government another $10,000, $15,000, $20,000 that you don't need to. And we're not talking about estate taxes here.
Yeah.
Estate taxes, you've got a $14 million exemption in 2025 per person with portability. Estate taxes are not going to apply to a lot of folks. But if you think about this, let's say you have $1 million in a non-qualified account, $1 million in a traditional IRA, and $1 million in a Roth account there. And let's say you want a third of your estate to go to a charity, a third of your estate to go to a son who wants to immediately purchase a home, and a third of your estate to go to a daughter who doesn't need the resources right away. Why, instead of just equalizing it and having all of them as equal beneficiaries on each of these accounts, what would be far more tax efficient would be to say, okay, I want the pre-tax resources to go to the charity because they're not going to pay any tax on that.
Yep.
I want my son, who's going to use all these resources right when he gets them, to get the non-qualified account because there's going to be a step up in cost basis. That $1 million will have no tax associated with it. It's also not going to have the advantage of the next, period of time having some tax-free growth. He's going to use it. He doesn't need it. He doesn't need that deferral or that tax advantage situation. Now, your daughter, who is going to hold these resources as long as she can until she has to take a distribution, let's just say, that $1 million, if she's able to keep it in a Roth, and let's just say that you get in that 10 years before she has to take out a full distribution, let's just say that she gets a rate of return that's 7% or 7.5%, she could see those resources double in that time. So that $1 million goes to $2 million, and she takes it out, a little bit over time, but most of it at the end of 10 years. Well, now she has no tax bill on that. Whereas if she had gotten the pre-tax resources or a portion of that, then they grow and she's got a tax bill on that. She takes some of the non-qualified resources. There's capital gains, after 10 years that she's going to have to pay if she uses it. So there's particular ways with respect to estate planning that you want to look at each type of account here and each level of distribution. The other thing that we'd say is, if you get into a long-term care type of situation that we talked about earlier, pulling resources from pre-tax places makes a ton of sense because you can offset that oftentimes with the cost for long-term care or medical expenses there with the deductions and such. So, let's just say that your daughter, again, is living out in California. She's at a 37% tax bracket, also has state tax. You leave that pre-tax resource to her, the government's going to take almost half of it, when she takes those resources out. Instead, if you take them out to pay for expenses that are related to long-term care, or your agent, your power of attorney, or your trustee, helps you in doing so, then you are able to go ahead and move that through the tax system, and then maybe allow non-qualified or Roth resources to continue to grow, and then she ends up getting those, not paying any tax on it. So it's really important to think about this in light of all of your goals, not just during your lifetime, but even after your death, to figure out what is the best withdrawal strategy in any particular season.
Absolutely. Well, and I think there's one of our mentors that says, we love each of our children equally, so we treat them all differently. And I think we could say that same thing about each of our accounts and our account types. We look at the entirety of the picture, but we have to treat them differently because they're taxed differently. There's different efficiencies and slowdowns that each of them experience. And so thanks for walking us through these tax smart distribution plans. As always, take this information to your CPA, to your financial advisor. Talk about tax location optimization. Talk about where should you be taking withdrawals from based on your specific situation. As always, clients, we would love to talk about this with you. If you have questions, feel free to leave them down in the comments below. We'll see you again next time. Take care. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.